if you have a growth goal that's 10% a year, you're not going to get there if you're just continuing to maintain an older product line that's near the end of its life cycle.
Where do you see the bottlenecks and the failures happening in that innovation process?
There's some typical symptoms that I'm seeing. There's really three. One is
Noel Sobelman is a leading innovation strategist, transformation advisor, and head of innovation practice at Accel. Known for cutting through complexity and driving sustainable growth, he helps organizations rethink how they innovate. With decades of experience and as a frequent speaker, Noel brings a clear perspective on aligning strategy, managing portfolios, and delivering measurable outcomes.
Innovation success really depends on more than just having a great idea or a great product. Too many companies have had great ideas, great products, but they fail because something in the value chain is broken.
So today I'm joined by Noel Sobelman. Thank you so much for joining, Noel. Noel's a leading innovation strategist and transformation advisor, worked across companies across multiple sectors and industries, helping them accelerate their time to market, strengthen innovation governance, and build high-performance teams. As I say, Noel, it's amazing to have you. Maybe you can really expand on that little intro that I gave.
Sure. Thank you, Ivan. And I'm looking forward to our conversation today. Yeah, my career has been in innovation and product development pretty much exclusively. About half of what I've done is in industry, working for mostly technology-driven companies, and the other half as a consultant advisor, helping companies build the capabilities. I work for a firm called Accel Management Group. I manage the innovation practice where we help companies in core business, product development, execution, portfolio management, also transformative innovation. We're doing a lot of interesting work with clients, helping them to identify and build completely new sources of growth, new categories for growing their businesses. Do a lot of work with companies to help them select and implement enterprise software systems that enable these practices. So we can certainly get into that today. And yeah, happy to be here. The other side I should say about Accel is that we also have a practice in operations. So we have people that specialize in manufacturing strategy, supply chain as well. But I focus exclusively in innovation and really across all industries. A lot of work in life sciences these days, but I've worked in everything from hair care to semiconductors.
And there's a spread. Brilliant. And Noel, you and I have known of each other, met each other a long time ago. It's super to have you on this session. And I know that in your organization, you talk about delivering growth strategy as well as innovation. I mean, innovation is a space that I'm super familiar with, but what do you mean by growth strategy?
The simplest way I like to think of it is the old where to play and how to win. And I just add with innovation. So there's lots of ways it can grow beyond organic innovation. There's expanding into new territories, new geographies. But most of the work I do is establishing where to play and how to win. And that where to play part of that, it gets into defining your opportunity areas. Where are you going to play? That's that intersection between the mega trends and where the markets have a nice growth trajectory, and then looking at your company's competencies and your assets. So I use a Venn diagram. So we're all three of those areas: mega trends, the markets that are growing, and looking at your company's core competencies. At the intersection of that, you have to look at what are the customer needs in those spaces. So I'm a big proponent of defining your segments or your where to play based on customer behaviors and customer needs. So needs-based segmentation is an important part of it. And then, of course, on the how to win part of innovation strategy is what's the approach you're going to use? Are you going to go after disrupting the market, leapfrog your competitors? Are you going to be a cost leader? How are you going to differentiate yourself? So I do a lot of work with companies to help them define that strategy and make sure that at the highest levels of the organization, it's clearly communicated. Mm-hmm. And often it's not.
Yeah.
I've gone into large companies and you interview the executives and they each tell a different story about that strategy. So it's really important to get that alignment on the strategy. What is the growth ambition, and making sure that cascades down into your innovation how you allocate investment across your different categories or growth horizons. What are your financial goals? And ultimately, what are the customer needs that we're going to go after? And then there's the whole execution side of that. How are we going to set up our systems to make sure we're operating effectively?
So you almost answered or talked about one of the problems I see quite often is that even where an organization has some form of strategy, you talked about the executives not necessarily all being on the same page. I think that's a fundamental problem, because if the executives aren't on the same page, the chances are that the senior leaders under that and the mid-level management under that, none of them know what the strategy is. Do you see a way that organizations effectively disseminate that strategy? Have you seen companies do that well?
Yeah, it's really a matter of agreeing what are the components of the strategy. Like I was saying, what are our growth goals? How are we going to allocate investments? Whether it's by growth horizon or product line or different strategic priorities. And then that needs to cascade down, because working with a lot of large companies, there's the corporate layer, then you got under that, you have multiple segments in many cases. And within each segment, there's multiple business units. And within each business unit, there's multiple product lines. So these large companies are pretty complex. So you really need to make sure that strategies cascades down to that next level, and you have to decide where you're going to govern it and make decisions. We typically see the best place to make decisions are at the point in that hierarchy where resource allocation decisions are ultimately made on projects. And that's typically at the business unit level. The leaders who have that P&L responsibility for a business unit, they need to make sure that their strategy is in alignment with the corporate goals, but they also need to have a balanced portfolio to make sure that they're hitting their goals. So they set their business unit strategy, and that needs to be reflected and communicated and updated for alignment with changing market conditions throughout the year. So it gets complex, but you need to really push the decision-making to the point where not only where the allocation decisions are made ultimately, but those closest to the markets and that understand the markets the best. So putting that structure in place, when I work with clients, we typically start but just by defining that organizational cascade or that structure. So and that kind of sets the architecture for a portfolio management system. So you need to know where are we going to make which decisions, who are the decision makers, where are projects prioritized? Is it within the business unit, or how do you incorporate your regional input into that? So getting all that figured out is really critical, and to making the right decisions at the right times. And then from there, then you can start thinking about, how do we get the data to the right places to make data-driven decisions?
So this is great. I was having a conversation with someone yesterday about exactly this, and one of the failings we often saw was that organizations lacked a single person who's responsible for strategy. So we talk about the board level setting the strategy. How often do you see someone who's actually accountable for overall delivery of that?
I think at the business unit level, it's ultimately the leader of the business unit, but the disciplines we're talking about cut across functions. So the leadership and the functions that are making the decisions, because a typical governance team would include not only the business unit president or general manager, but you also have the heads of marketing or quality and R&D. These kinds of decisions cut across functions. So a lot of this is about breaking down silos, and people are uncomfortable with that, because if you're an R&D leader and you're used to making the project prioritization decisions for the technology side of the business, you're kind of going to feel like you're losing power if that decision is made by a cross-functional governance team. You certainly have input into that, but it's critical that they're aligned, because we all know innovation, product development is inherently cross-functional. There's no one function or one leader that's ultimately responsible. But ultimately, the CEO and the heads of the business units have to communicate that strategy, have to explain the why. They have to explain the opportunity areas, so we know that we're not designing flying cars if we're not in that business. What is in bounds? What are the boundary conditions that we're going to operate in based on the analysis of the where to play, and then walk the talk. and not just talk the strategy, but actually use it to inform decision making and project prioritization. So it's championed, it's led by the leader of the business unit if you're at the business unit level, but you have to have alignment across the different functions that have input into getting a product from idea to market.
And that, I think, is where I often see organizations struggle, because a lot of them don't have I talked about a central leader, but they also don't have a central function responsible for coordinating across all of these areas. So I had a conversation yesterday about, if you hear the words PMOs, and I think I hear more and more the words changing to VMOs, value management offices. It's been called lots of things, but quite often it sits at in a delivery space for delivering execution, but not coordinating across everything. Do you see organizations that manage to have an effective part of their organization that monitors this strategy execution across the entire business, so that the executives actually understand, are we on track across the entire portfolio transformation?
There's a couple of sides talking about that question. There's the strategy side, and then there's the operational side. And PMOs, for example, one of the problems I see out there is that if I sit in on a lot of portfolio reviews where the executives get together and they march the project teams in, the project teams give a status update. Now, that's not a portfolio review. An effective portfolio review is when you're making their decision forums, that you're making decisions about what should we do to maximize the value of the portfolio, to eliminate bottlenecks in terms of resource allocation, to make sure that our highest opportunity projects are getting funded, even if it means saying no to some things or slowing down some things to improve to accelerate others. So in order to do that and make that portfolio review effective, we like to separate analysis from decision making. The analysis side of that are the people that are collecting the data, running the analysis in tools like Edison 365, and they're looking at the different views of the portfolio, the different metrics you want to look at, where there's uncertainty, what progress you're making with evidence where there's uncertainty, and they bring to the portfolio review a set of recommendations on how we should adjust priorities or adjust the portfolio to make sure that, again, we're maximizing the value and we're improving our throughput, and we're setting up our project teams for success. So there's a portfolio analysis team, and they bring recommendations to a decision team, which includes the leader of the business as well as the different functions we talked about. So that forum starts with, okay, what's changed in our markets? How are projects tracking to their timelines? And let's have conversations about what needs to change based on what we're seeing. So we're not just static. We're making updates or we're correcting throughout the year as conditions are evolving. So all those mechanisms, defining the governance, understanding what kind of views of the portfolio you're going to look at, how it aligns to strategy, lots of moving parts, but it typically comes together certainly it comes together at annual planning time, but it doesn't stop there. You have to continue throughout the year checking in. Whether it's quarterly or monthly, you need to check in and make sure, depending on how dynamics your markets are, make sure that you're checking in and making adjustments as needed to stay competitive.
And when you come to driving the innovation that's going to drive the delivery and the execution, where do you see the bottlenecks and the failures happening in that innovation process? There's
some typical symptoms that I'm seeing. There's really three. One is rampant incrementalism. So often companies will take the safe route and they'll take existing products and they'll make them slightly better, or they're spending. In one case, I was working with a client who was spending up to 70% of their resources on sustaining and maintenance activities for an aging product pipeline. Well, if you have a growth goal that's 10% a year, you're not going to get there if you're just continuing to maintain an older product line that's near the end of its life cycle. And many companies make that mistake because they have to hit their quarterly numbers. And so that suggestion that comes from the field from a large customer, you're going to say yes to that more than not because you want to keep that revenue where it needs to be quarter over quarter. So it's really hard to step back and say, we're not going to do some of those short-term opportunities in order to go for some of the longer term, higher risk reward kinds of opportunities. So breaking that cycle of incrementalism is a big challenge out there. And we can get into talking about how companies do that. The other challenge I'm seeing is just the resource constraints. A lot of companies still don't say no enough. They basically set their plans for the year and they say yes to too many things, and they load their developers up to capacity, and then throughput ultimately suffers. So managing that supply and demand of resources relative to being realistic about what it's going to take to execute and deliver. The metric needs to be throughput, not how many projects are we going to put into the pipeline. Because when you run into bottlenecks and constraints, you're going to disrupt the pipeline, and you're just not going to get the throughput or predictability that you need. And then one more I think is important is just that strategic misalignment, that ambition or that growth goal that's in the double digits. Yet when you do a bottoms up analysis, there's a disconnect, there's a gap. So long range planning integrity is what we call it. So we've been asked to come in and do an analysis of okay, we've said in 3 or 5 years in the long range plan, we're going to hit these numbers 5 years out. And then when you do a risk reduced roll up of what's in the pipeline and what's planned for the pipeline, there's executives are surprised, but there's a pretty significant disconnect or gap, I should say, relative to those long range plans. So holding R&D accountable is important. Yes, there's uncertainty and you can't predict the future, and not every project's going to be a winner. So you just have to understand where you are, and if there is a gap to your LRP growth goals, what are you going to do about it, and how are you going to balance the portfolio to be more realistic about hitting those growth goals? And again, it might mean investing more in higher risk reward types of projects in order to move the needle.
Yeah, and do you think that both? I mean, the first issue, incremental, and the third issue around the gap in the portfolio is a symptom sometimes of incremental change is typically much safer than more transformational work. And I mean, you look at the stats on transformation, and 70% of it, in theory, according to the stats, is a failure. So, do you think that's why, as a manager or a leader, it's the easy route is to play it safe and focus on incremental change?
That's a big part of it, and just getting comfort with, if you are going to go after a more balanced portfolio with investment in completely new categories, certainly new products or adjacencies, you have to get comfortable with uncertainty. And that's where I wrote an article a couple years ago called Evidence-Based Decision Making. How do we quickly reduce the uncertainty by running experiments, learning very rapidly from our customers whether or not there's a true opportunity, whether it's technically feasible, whether it's going to delight the customer, and if the business model is robust. So quickly reducing those before you start ramping up your development resources, really de-risking that early. And there's techniques to do that well with regard to things like metered funding. There's lots of work's been done to in that transformative part of innovation. So making sure you're governing that appropriately, because it's very different when you were talking about the transformation space. It's very different than your more linear gated development processes where it's more predictable, so you can pretty much turn the crank and predict what the outcome's going to be. It's closer in, the markets are more well known. It's when you're getting into those new spaces that you're dealing with that uncertainty. So at the very highest levels of the organization, how much are we going to invest in that category, and how are we going to govern that to make sure that we're de-risking and managing a portfolio and quickly narrowing that portfolio down to the ones that are proving through evidence that they're worth spending another tranche of money on, and making sure that we're advancing those, and at the same time keeping the innovation engine or the core business predictable. So it's that ambidexterity that is a challenge, and most executives are good at the scaled business, managing the core business. There's different approaches, different techniques that are more startup like in coming up with a completely new category of product. Managing those at that paradox is very challenging. But I think we're making a lot of progress in that area at the same time. And there's a lot of research that has been done, and a lot of companies are starting to see success with that model.
You use the terms dynamic portfolio management. Is this all part of that process?
I use the term dynamic portfolio management because that gets into your stage of maturity in that discipline. So many companies in the early stages of growing a portfolio management capability, they have what I call static capability. They have their annual planning process where after months of analysis, it comes together. You set the goals for the year. You figure out your projects you're going to do, your project priorities, and then you execute throughout the year. So it's very static, and that's typically characterized by pulling data off of disconnected spreadsheets. There's a lot of times in those early stages of maturity, there's data trust or data integrity issues. And whenever you're pulling data off of disconnected spreadsheets, there's going to be challenges with that. There's a lot of work that's put into pulling the data together. And then you get together, you make a decision on what the project priorities, and like I say, you execute throughout the year. When companies get more mature, they have the capability now to do what I call real-time portfolio management or real-time decision-making. They have the data in a common database, in a system that allows them to, at any point in time, roll it up to at any level in that hierarchy and have the data ready for the decision makers whenever and wherever it's needed. So it's more real time. So moving from that static once a year or a couple times a year, looking at the portfolio to more frequently is that transition point. And markets and technologies are just changing too quickly to do the static approach. You need to have the ability to mid-cycle make course corrections. Executives need to constantly looking to prune the portfolio of projects that aren't really moving the needle and reallocating those resources to the higher potential opportunities. And that takes a dynamic approach.
So, of course, I'm 100% agreeing with that, Noel, because I just don't believe you're going to deliver effectively in this day and age, or unless you're able to make decisions rapidly. It's just everything is changing. You need to correct so rapidly, and you need the information, the data. That's one of the reasons that we created Edison way back 5 years ago to do this. One of the biggest issues I come across, and something I have a passion for trying to cure, is that specifically in innovation, so not so much in the talking about portfolio delivery people, and really this is especially in disconnected organizations, is that innovation teams often fall victim to the fact that they fail to prove value from what they're doing. The measure of success is not how many new things we've come up with. What an executive really is after is, what's the value that you've provided? What do you think is key to solving that?
Well, I think you have to measure. You have to establish metrics that matter across. I typically help companies set up metrics across three categories: your innovation effectiveness, your project performance at the project level, and then your application of the process. And I can give examples of metrics in each of those categories. But ultimately, it's about revenue growth. If you're in growth mode, it's about revenue growth and return on innovation investment. And then there's productivity metrics like resource utilization and bang for the buck. So there's different metrics depending on your strategic goals. But when you talk about innovation effectiveness, it gets back to I'm a fan of the new product revenue contribution, or your vitality metric. Most companies use some form of that. Your R&D effectiveness or your return on R&D investment. I like measuring lost or wasted development spend. It basically, what's the cost of projects that don't even make it to market? You want to do that early, like I was mentioning before you start really ramping resources. So ultimately, you want it to be zero, but there's always going to be some fallout. So there's always going to be, that's a good metric to measure. On the project performance side, it's your time to market, your time to profitability, schedule predictability. At Accel, we benchmark all these metrics in multiple industries. So one of the things we do early on that I encourage executives that are kind of taking on an initiative to improve these practices is to first understand, where do we stand relative to our peers and even other industries? Where do we stand in terms of our time to market, our schedule predictability, our return on innovation investment? Let's understand where our performance gaps are, so we can really zero in on and get the most for making improvements. So establishing those metrics and measuring those and looking for year-over-year improvement is critical. And there's a whole different set of metrics when you get into transformative or new category innovation space. It's more about your new venture revenue contribution, or how many assumptions are we validating? What's our learning velocity? How is our external ecosystem engagement? That's an important piece of this. And of course, that evidence-based portfolio value. Are we progressing our projects based on evidence strength over time? And are we saying no and killing the ones that aren't producing the evidence that we need to validate in order to fund the ones that are showing promise?
And how about the evaluation after the fact? That's the thing that I don't see being performed particularly well. A lot of once the project is finished, once we've delivered something, it's all viewed as great, and we move off and do something else. But the value from these are quite often 6 months, 12 months later. Do you see? It's a space that I don't see the effectiveness that we should. But have you come across that?
Yeah, that's the ultimate metric, and too often we celebrate launching the product, but the success metric for a project team is success in the market. Yeah. So you absolutely have to track how you're doing relative to your projections, and that project team at the project level should absolutely stay intact while you're ramping to volume. Unfortunately, that's oftentimes a lagging metric. Some of the metrics, you have to understand the difference between leading indicators and lagging indicators. But by the time you see the success or the lack of success at the project level, the team's off on the next project. But you still need to capture that data and learn from that and do the postmortems. That's something that we're asked to come in and do an objective postmortem analysis of a project. And what we'll do is we'll get the team in a room and we'll map out what actually happened from idea all the way to market, and then look at the data in the market, and we'll look at how they did relative to how they planned the project, both from a business case and from a schedule and operational perspective. And we'll look at we'll really do a 5-why deep dive into the root causes of where some of the disconnects were. And also when you're successful, let's learn from what happened, what we did that was successful, and understanding that as well, so we could reapply that to new projects. So that postmortem analysis is really important at the project level. But at a portfolio level, yes, are we meeting the goals that we established for ourselves in terms of whether it be growth or investment allocation and resource utilization? We should be tracking that. Tough to do, again, if you're on those disconnected spreadsheets. But if you have, this is where the value of enterprise software comes into play. A lot of this is tracked within those systems, and you can produce the reports. You've got to make decisions based on those reports. It's not just a reporting tool. It's about getting the data to the people that make the right decisions.
We're from a software background, so of course we've got an axe to grind. I don't think I've never been a believer that software is the be all and end all of this. It's the enabler, but I think it's in the scale of organization, it's nigh on impossible to make a decision on things unless you've got up-to-date information across the end-to-end process. So when we talk about the portfolio, not just the portfolio of live projects, but also the funnel that's coming into this, the innovation pipeline tied to the strategy. What do we start? What do we accelerate? What's delivering value and what's not? I can't see how you could effectively do that across an organization without a piece of technology, that's going to enable it.
Yeah, and on the other side, I think there's a little bit of a caution. We always say, the person that wants to lose weight, they buy an exercise bike, and they think that's going to be the solution. When you apply that analogy to implementing an enterprise software system, if something goes wrong, yes, the tool often gets blamed. However, you still need the governance systems, the processes, the disciplines that we've been talking about around decision making. Too often I've seen companies spend a lot of money, a lot of effort implementing an enterprise tool, and they use it to produce reports. And then the users at the project level, leadership at corporate just wants to know what I'm working on. And you get that resistance to change there, and it never gets adopted. The real goal is using that data to make decisions. And I'm actually writing a book now on this whole portfolio management topic, and I spend a good chunk of the book just talking about adoption of both systems and processes, and what it takes to really get these practices to stick in a large organization. And it really is a journey, but you got to get started and you got to get better over time. But it's a tool, but there's a lot of practices in order to get the value out of the tool, like you mentioned. It's an enabler at best. So, but oftentimes implementing an enterprise system can be a catalyst for change too. So just make sure that you're not automating poor practices.
For me, critical to any of this is investing in the ability to change, because just telling somebody we're going to do enterprise portfolio management and we're going to have a great new system is not going to make it embed itself and produce the results. You've got to invest in the change process to get people to understand why, what's the benefit, why are we doing this, what's in it for the individual user. From a technology provider, we want customers to invest in the change and to have the processes and to have the strategy and to have the organization, because then we know our software is going to deliver the value they want and it's going to stick there. So I agree. I'll be interested to read that book, Noel. I hope you're going to send me a copy of that once it's ready.
You bet. Look, probably late this year, maybe early 2027 is the target. So
I love that. I can't wait to see that. So yes, please. I'm looking forward to that. Now, I'm conscious we're coming. We could go on for ages, but I think a final question for you. This is always a tricky question. It's the one that everyone asks at the end of these sessions. But really, from your perspective, next 3 to 5 years, what's the most exciting shifts in innovation, portfolio management in this space that you think is going to happen?
Yeah, I think it's the whole concept of going beyond your four walls, or ecosystem innovation. So innovation success really depends on more than just having a great idea or a great product. It requires ensuring that all the interdependent elements in the ecosystem are aligned and ready to deliver that value to the end user. And oftentimes that ecosystem means external parts of the value chain of delivering that value. So companies need to evaluate the readiness of the entire system for success. So that's, I think, going to be an important enabler in the next 3 to 5 years. Companies that are good at managing that ecosystem and understanding the value you add in that ecosystem and learning how to work with partners is going to be critical. Too many companies have had great ideas, great products, but they fail because something in the value chain is broken, and there's plenty of examples of that. So that whole area of ecosystem innovation is going to be more and more important going forward.
Thank you for not saying AI, Noel. We didn't get a chance to talk about that, but that's normally the answer there is AI.
Well, yeah, we could talk a lot about, there's a lot going on in AI that enables what we've been talking about, but I'm glad we got through a whole session without bringing it up. I think that might be a relief for some people. But seriously, though, in terms of project scheduling, predicting the resource planning we talked about, scenario modeling, and that continuous portfolio optimization, AI is going to be definitely an enabler for that. There's parameters that you can load into the system and get smart. I think the key, though, is really getting the data cleaned up. Yeah. Just like you have to for any enterprise software, you have to have reliable data that you're drawing off of, and you don't want to automate those poor processes. So definitely, there's a role. I'm excited about what AI is going to bring to the portfolio and innovation space for sure. We could do a whole webinar just on that.
Yeah, but actually, you've said something no one else has said, and it's absolutely fundamental. Noel, I agree with you. If you have AI working on stuff that's not relevant, it's your answer's just not going to be relevant. So the fundamentals of getting engagement with people, getting the right data in, getting accuracy and quality mean that AI will have a part to play. But yeah, I love it. Thank you so much, Noel, for the session. I super appreciate it. I am looking forward to the copy of the book. Can't wait to see that, and look forward to having another chat with you anyway. We've talked about over the coming weeks. So much appreciated.
Thanks, Ivan. It's been a pleasure.